It begins with a rupture so sharp that even veteran investors feel the jolt before they fully understand it. A South Korean engineering contractor called Samsung E&A, closing at about 25,550 KRWs on November 28, 2025, and showing a full year of nearly 40% appreciation while displaying financial and operational signals that normally do not coexist in an ordinary engineering procurement and construction cycle. This level of contradiction is not only unusual, but structurally improbable. And that improbability is exactly why it demands attention from anyone following the story closely. Under ordinary conditions, engineering, procurement, and construction firms follow well-known cyclical rules. When revenue declines, cash usually tightens. When new orders fall, liquidity tends to shrink. When a mega project is secured, adjacent business segments almost always show follow-through growth because clients interpret the win as proof of execution strength. These patterns exist because engineering, procurement, and construction work is capital-intensive and dependent on predictable multi-year project behavior. But Samsung E&A breaks those rules completely. Over the past 12 months, its revenue slipped from about 10 trillion KRW to around 9 trillion KRW. Quarterly revenue fell roughly 14% and net profit fell about 13%. Normally, that kind of decline forces contractors to borrow more and carry heavier working capital burdens. Samsung E&A did the opposite. Its cash jumped nearly 80% year over year, and its debt fell close to 7%. This is not how engineering, procurement, and construction firms behave when revenue contracts. This is the first anomaly, a financial split that looks more like deliberate preparation than distress. The second anomaly is even more striking. In early 2025, Samsung E&A won the TA'ZIZ methanol megaproject in Abu Dhabi, a facility designed to produce about 1.8 million tons of methanol per year with strict low-carbon efficiency standards. The engineering, procurement, and construction contract is worth about $17 billion and spans 44 months. In this industry, wins of this magnitude usually trigger a wave of secondary growth. Environmental engineering expands, water processing projects accelerate, biotech and industrial orders grow. Clients treat the mega project win as a certification of capability. Under predictable industry logic, non-hydrocarbon bookings should rise sharply. Instead, Samsung E&A saw them collapse. Non-hydrocarbon orders fell from roughly 1.4 trillion in early 2024 to around 150 billion KRW in early 2025. That is not normal behavior. A globally competitive contractor should see order acceleration, not disappearance. Clients normally increase demand, not withdraw it. The expected pattern is diversification, not contraction. The fact that the company experienced collapse instead of expansion is the center of the mystery. Why would a contractor capable of winning one of the world's largest low-carbon chemical projects suddenly report a nearly empty pipeline in a segment that usually reacts positively to such wins? There are several possible explanations, and each one carries weight. One explanation is strategic concentration. A $17 billion project may require such heavy internal reallocation of engineering, labor, procurement, bandwidth, supplier integration, and risk modeling that leadership slows new bidding to avoid overload. This would be unusual because most engineering, procurement, and construction firms try to diversify their workloads to stabilize margins, but Samsung E&A carries the memory of the period from 2013 through 2015, when it suffered losses exceeding 1 trillion KRWs on Middle Eastern projects. After surviving losses of that magnitude, the company may now choose extreme caution, prioritizing perfect execution over new order growth. If so, the drought in non-hydrocarbon orders is not weakness, but discipline. Another explanation is invisible pipeline buildup. Engineering, procurement, and construction pipelines often include confidential early-stage engineering work that does not immediately appear on public order books. Under ordinary circumstances, even confidential negotiations leave small signals like early design studies or technical mandates. Here, those signals are missing, which suggests sensitive negotiations or tender processes that have not yet surfaced publicly. In that case, the order gap is temporary rather than structural. A third explanation is cycle distortion. A mega project as large as TA'ZIZ can distort a company's segment mix for several quarters. Normally, the distortion is softened by smaller inflows from other segments. Samsung E and A's distortion is extreme, which hints at strategic repositioning rather than short-term fluctuation. These anomalies matter because the TASI's project is not a traditional hydrocarbon job. It is the first methanol plant in the United Arab Emirates, and its design is anchored in low-carbon output. It is central to ADNOC's long-term transition agenda. Executing this project successfully would shift Samsung E and A from a regional contractor into a global builder for the low-carbon industrial era. For investors, this is not just a contract, it is a directional signal stretching across the coming decade. The stock's technical behavior reflects that tension. At about 25,550 KRWs, the price sits just above strong support between roughly 24,500 and 25,000 KRWs. The relative strength index in the low 40s shows neutrality, meaning the market is waiting for information rather than reacting emotionally. A short-term rebound toward 27,000 KRWs is possible. The medium-term battleground is between about 28,500 and 3,000 KRWs, where narrative validation typically occurs. A breakout would imply that execution on the TASI's project is progressing cleanly or that non-hydrocarbon orders are beginning to recover. If both conditions align, long-term valuations cluster between roughly 32,000 and 35,000 KRWs. If early execution issues emerge, the stock could slide toward the low 20,000 KRW range before stabilizing. So investors are left with the unresolved question: why does Samsung E and A produce a combination of signals that do not ordinarily coexist? Rising cash, falling debt, shrinking revenue, a mega project win, and a collapsed segment pipeline do not form a standard ecosystem. They form a transitional one, pointing toward consolidation, internal asymmetry, or undisclosed opportunity. Samsung E and A is now at a strategic hinge. It is either preparing for a generational shift toward low-carbon megaprojects or dealing with internal imbalances that remain hidden. The truth will unfold through evidence coming out of Ruwais and through the reappearance or continued absence of non-hydrocarbon orders. And before we close, listeners of the Valuester channel should know we actively welcome your tips and leads about listed stocks, private companies, upcoming IPO names, and even coins you want us to investigate next. Drop them in the comments, since your submissions help shape future episodes and your engagement makes these deep dives possible. To everyone who watches, subscribes, likes, comments, and even shares these episodes outside this platform, thank you. Your enthusiasm keeps this channel moving forward, and we will return it with even stronger analysis and better storytelling. This was Valuester.